Welcome to the Strategic Insight Global research update. It is a research update, but we're also dealing with one of our new in-depth studies, which is called Building Bridges. It's a book, the third book of our Asia Fund series, and it deals with us having, in the last couple of years, interviewed the leading regional institutions and distributors on what's important to them. So what we did since the crisis is talk to about 1,200 distributors and institutional investors, and in the last 6 to 10 months we did this specifically in Asia across 12 different markets. So it's Asia Pacific, including Japan and including Australia. This video is going to talk about the asset size and the opportunity, tactical opportunities, as well as some contradictions when it comes to flow, aggregate flow numbers. When you look at Asia, it's an important thing to note, it's an important element to define it right. So oftentimes Asia is seen as Asia ex Japan from a business standpoint. However, if you look at the global asset management industry holistically, today you have a record number. As of May 2011, you have 31 trillion in assets. That's even higher than before the financial crisis. The 31 trillion are split up in the US, where you have 13.3 trillion. The European markets, and that includes UCITS, non-UCITS, cross-border and local funds, with about 10.6 trillion, but really only 10.1, because half a trillion of the UCITS cross-border universe is now coming from Asia. So there's an important trend for UCITS to be used in Asia, and as many of you in Asia know, it's primarily in Hong Kong, in Singapore, in Taiwan, in some other markets, but in general there's some markets that use the offshore fund piece, and there are many other markets that still are more local in nature. That local universe is about 1.1 trillion. The Japan universe is about 0.7 trillion, and Asia, in terms of Australia, is 1.4. If you add these pieces up, you get to 3.7 trillion. So while Asia is still relatively small, it's not as small as many make it out to be. If you include Japan and Australia, clearly they're very different from a local market perspective, and industry drivers are different than in the rest of Asia. But we know that the region itself is not a region. It's a multi-local approach, many languages, many regulatory frameworks. It is a more complex market, but it's also a growing market with 3.7 trillion. So you have, and that's what we do in this book as well, projected growth once you combine the institutional opportunities, which are growing, which have grown in the last couple of years tremendously. So a lot of the growth for large fund managers in the last few years was from the institutional channel. Secondly, you have the high net worth opportunities. That is not new. So ultra high net worth growth and opportunities have always been there. They just have often gone through Switzerland or Singapore as a private banking hub. That will grow as well. But the third component in the next 15 years that we expect to grow a lot towards the latter part of the decade, so in 6-7 years, is the small ticket item. So the 401k business size, where you have small monthly contributions from a middle class investment base that will significantly contribute at some point to the industry growth. You lack, of course, at the moment, a regulatory framework or even a tax framework, because taxes are lower than what you have in the US with matching 401k plans and higher tax rates. Or you're also lacking a regulatory framework that, even with the European Union, has sort of an overlay regulatory-wise. But that notwithstanding, it's only postponing the opportunity. Because you know, firms like Franklin Templeton in 2005 started their Academy for Financial Advisors. So there's a long-term trend towards educating investors around diversification, and that's a big opportunity. So the tactical opportunity, which is the second point for this video, is that since the crisis, some firms contributed more and committed more to Asia, and they really gained market share on the institutional base and in second-tier markets. So you look at Southeast Asia, and that has grown. And then aside from that, you have, on a tactical basis, those firms that did not commit. They withdrew. They basically had to cut fixed costs and let people go during the crisis, which meant that when a client had a question, They couldn't reach their client relationship manager, and they now decided that they don't want to work with these firms anymore, and at least wait another crisis, or at least a couple of years, to prove to them and to their clients that they will be there, creating an opening and a tactical opportunity for firms that are thinking about entering the region to do that now. So there's a tactical opportunity this year and next year to really gain market share simply because other people made mistakes. Which brings us to the third point, and I touched on that. The flow picture is a little contradictory. So sometimes you look at the flows or the asset size and you think you have to go to North Asia into the large markets, Japan, China, or you have to go into the markets that have massive net flows. But often smaller aggregate flows hide an opportunity underneath where the zero-sum game does not mean that there's nothing going on. There are a lot of inflows and a lot of redemptions, which means that some companies are winning. And we have seen a number of committed firms to Asia in the last couple of years winning in second-tier markets. So from an operational perspective, it's good to go in now, because you have 18 months or so to really win tactically. And it is good to think about which markets you want to go into, because sometimes the more competitive, lower margin markets are not the biggest opportunities. That's the asset picture and the flow picture. Clearly, on our survey, we touched many others, but this is the first update for the Asia book, Building Bridges and Having Success in Asia.